Good morning, ladies and gentlemen, and welcome to the 2024 Q1 Bertrand Financial Market and Economic Update webinar. I'm Alex Cabot, and with me, as always, my good friend and business partner, Ed Lambert. First and foremost, I want to make sure that everybody can hear me. If you can hear me, can you please click on the raise hand icon just so I can see that everybody is... All right, looks like most everybody has clicked it. So apparently it is working to enough of a degree that we can hear one another. So I will put everybody's hands down. Thank you very much for that. I appreciate it. Secondly, I'd like to wish everybody a happy spring. The first quarter ended and spring arrived, and the days are getting longer, and it's certainly a gorgeous day out there. So we'll try to keep these comments as concise as possible so that you can all get back to enjoying a beautiful Friday in April. It was a couple of housekeeping items before we get into the prepared remarks. This webinar is being recorded, will be available for replay sometime next week. That'll be sent out. We'll be attending a conference, Raymond James National Conference, next week, so it may be a little bit delayed beyond that, but we'll get it out as soon as we possibly can. There will be time for questions and answers at the conclusion of the prepared remarks. If you do have a question, simply type it into the question and answer box and we will get to them at the end. Or if a question comes through and we see it and we can answer it in the middle of the presentation, we will do that as well. Finally, kind of an exciting announcement. This webinar will also be available on our new YouTube channel. That is a brand new thing that we've just rolled out. We only have a couple of videos uploaded now from our website, but we are going to continue to make new content for the YouTube channel with educational and informative short snippets and also recordings of our webinars. So if you get a chance to check that out, just go to YouTube. It's at Bertrand Financial. We're very easy to find. Like I said, there's only a couple of videos there now, but hopefully we'll have a lot more content as the years go by, and who knows, we might become influencers out there. But it's definitely not a career change that we're looking to make. So we'll get to the prepared remarks now, and if you have questions, please type them in the box and we'll go through them. So the first quarter of 2024 was a bit of a continuation from the fourth quarter of 2023. Fourth quarter of 2023, starting around Halloween, we had a very strong rally in the capital markets. Concerns about inflation and interest rates started to ebb, and the market rebounded very sharply. We closed out the year in a very good way. 2024 continued the same vein. We saw the inflation continuing to moderate. The Federal Reserve had pointed to some possible rate cuts, and the markets were continuing to climb throughout the first 3 months of the year in a broad sense. Largely driving that, economic data were very strong. We haven't seen, now this is the first quarter. We just had a GDP print yesterday that was a little bit weaker than we were expecting. But throughout the first quarter, the data were extremely strong. Ed's going to talk more about that. We have some charts and he'll go through it. But when I say the economic data are too strong, remember, we're fighting inflation. In order to fight inflation, we have to slow down economic growth. And if you have continued extremely strong results from everything, it's very unlikely for inflation to come under better control. But Ed will talk a little bit more about the economic data as we continue. Conflicts, the two major conflicts we're seeing right now, obviously Russia-Ukraine is still going on, and Israel and Hamas is still going on. So far, nothing has spilled over into the broader capital markets, but it is something we are continuing to keep an eye on, and it is a risk. It's not a significant risk, but it is a risk still, so it's something we just have to be aware of. The other large driver of the markets in the first quarter, AI, dominated headlines across all sectors, and a handful of companies have done extremely well in the wake of all these AI advancements, and they have pulled back recently. But a remarkable run and an incredible technology. If anybody's had a chance to play around with AI, like ChatGPT or some of the other versions of it, it's an absolutely fascinating technology. And the first iterations were interesting, to say the least, but the new ones are very impressive. So I encourage everybody to check out some of the new technology that's out there. And then the final update from the quarter, not really an update from the quarter, just the further progress into the the upcoming election, and we've got the 2020, the sequel to the 2020 election coming up in November of 2024. Again, nothing we've seen has triggered really any volatility or uncertainty from that just yet, but there often is a short-term spike in uncertainty and volatility when we get closer to the election. So again, something we'll be keeping an eye on, and we'll keep you informed as best we can. Moving on to the asset classes of note. Of all the major asset classes that we normally show, most of them were relatively strong. A couple were slightly in the red for the first quarter, but nothing too significant. But of these major asset classes, one stands out, and that's the S&P 500 net total return, going up almost 10.5% in the first 3 months of the year. Not a characteristic return in the short run, largely driven by some of the heavier weighting towards the tech stocks and the AI driving technologies that make up that index. The other assets probably represent a little bit more realistic move of where the market should have been, but we're going to take it when we can and rebalance when necessary. And interestingly, if you break the S&P 500 down into its broadest components, that being growth and value, the growth outperformed the value by over 5%. The growth portion of the S&P 500 was up 12.6. The value was only up 7.4. So we're seeing a significant drive from these larger, higher tech companies, and that's been driving a fair amount of the growth. And it can create problems if you have some parts of the economy that are expanding so much faster than others. But as long as we're reasonably balanced and we rebalance when necessary, we don't think it's really a fundamental threat to an asset allocation. But we, of course, invite people to ask questions if they do have specific things about their own portfolio that concern them. Looking back at how the market has done, we did close the quarter in record territory. This is a neat little chart that just shows what percentage off of the all-time high in the stock market is. And as of the end of the last quarter, we had reached our all-time high and then crested over it. So we're at an all-time high when the quarter closed. We had been down about 24%, 23, 24% from it back in the end of 2022, rebounded very nicely. And same story as last quarter, the bond market is not back up to where it was at its peak. It still has quite a ways to go, about 10.5% below its all-time high. That does make sense given how bonds are priced and how equities are priced. But just know that if you're looking at the S&P 500 reaching its new all-time highs and looking at your portfolio and it's not quite back to where it was, bonds still have a way to go. They're still a very important piece of an allocation, but they just move differently than stocks, and that's why we invest in them over time. But they will, they'll continue to move as they do. They'll continue to kick off income as they do, and that's what their purpose is. Volatility, particularly in the stock market, has remained very muted as the year has begun. This chart goes all the way back to the beginning of 2020. So the massive spike on the left side is when COVID first reared its ugly head. And then it slowly ebbed down from there, and it's been bouncing around the 20 range. But for the last 12 months or so, we've been sub 25. And for the last 6 or 7 months, we've been sub 15, which is very, very calm in the capital markets. We're not saying this is the sign of anything to come. It's just an observation. A lot of other economic data warrant evaluation, and Ed will cover some of that as well. But for the time being, volatility has been very manageable. We did see a pretty significant rise in equity market valuations. Now, I normally cut off my charts at the end of the quarter, but I wanted to show this one going out another couple of weeks. So this chart actually runs to the 15th of April. And you can see right at the end, it starts to drop off. And we did have a pullback in the markets as April began. But valuations did rise pretty substantially. Some of it driven just by price appreciation, but some of it driven by the expectation that some of these higher technology companies will be able to increase their profits dramatically as time goes on. So there was some legitimate expansion, maybe a little bit of irrational exuberance mixed in there, but some of that exuberance has been pulled from the market as we've had a bit of a pullback through the month of April. And then the fundamental driver of capital market performance is corporate profits. How are companies doing? Are they making money? Are they making more money? And the answer is an unequivocal yes. Companies in the United States are continuing to increase their profit margins. And as of last quarter, the last quarter that was reported, U.S. companies reported absolute record profits, $3.414 trillion over the course of the previous 12 months. So a very impressive run in the business world in the United States. Again, just a testament to the fact that we go through very challenging times and we come through them stronger and we make it work. And it's an interesting environment that we find ourselves in, but then again, it always is an interesting environment we find ourselves in. And somebody once said, and I think I may have mentioned this on a podcast or a webinar months ago or even years ago. Somebody once said that we're living in uncertain times, and I challenge anybody to find a period in history where the world was quote unquote certain, because I don't think there is one. So that concludes my prepared remarks on the market. I don't think we have any questions that have come in. So with that, I will turn it over to my friend and business partner, Ed, for his comments on the economy. Ed?
Thanks, Alex. Hello, everyone, and happy spring. So moving on to the economy. Growth has been quite strong in the U.S. despite the Fed raising interest rates significantly over the past 25 months, with the first rate hike being March of 2022. And for the full year 2023, GDP growth was over 3%, which is certainly above long-term trend line. And you'll notice that annual growth hasn't gone negative since the rate hike started, despite many economists and investors assuming that a recession was a foregone conclusion. Now, just yesterday, and Alex made a mention of this earlier, the government released first quarter GDP growth, which slowed to 1.6%. This was well below expectations, but was driven primarily by a widening trade deficit, which was driven by a stronger dollar due to U.S. interest rates being higher than in a lot of places overseas. Domestic demand for goods and services actually grew at a relatively solid pace. Nonetheless, this certainly bears watching. A recent Wall Street Journal poll of economists suggests an average probability of recession of 29% over the next 12 months. A year ago, that was 60%. And to give some perspective, the random chance of recession in a 12-month period in the U.S. has historically been around 15%. So generally what we've seen, certainly over the last 5 or 6 months, this all started right around Halloween, was economists getting more and more optimistic, or I think a better way of putting it is less and less pessimistic about the possibility of the Fed creating a recession through rate hikes. Now, our next slide shows the number of job openings in the U.S. This is called the JOLTS report, the Job Openings and Labor Turnover Survey. And after reaching a pandemic high of around 12 million openings, the number at this point has declined to slightly under 9 million. Now, on the surface, this may appear to be a negative thing, but it's not. It's actually quite positive and what economists have been looking for. The reason why is an excess of job openings tends to push wages and prices higher. More of a balance between job openings and unemployed workers tends to keep inflation in check. And to give some perspective on the state of the job market at this point, the number of workers who are technically unemployed right now is around 6 million. That means that there are still roughly 1.5 openings for each unemployed worker. While this is much more in balance than the 2-to-1 ratio we saw a couple of years ago, a lot of economists think that getting this ratio a bit lower towards parity is very, very important for managing long-term inflation in the country. Our next slide shows the labor force participation rate, which is calculated by dividing the number of people either working or looking for work by the total adult population. And you'll notice we've been between 62 and 63% recently and have rebounded from the big drop during the pandemic. And where we are now is honestly unlikely to change in the near future. As baby boomers retire, new workers replace them at roughly a 1-to-1 ratio. Goldman Sachs estimates that the US job force will only grow by about 0.5% a year over the next decade. And believe it or not, that puts us ahead of many other countries in the world. Now, from a longer term perspective, if you can envision kind of expanding the graph backwards, the current participation rate is approximately where it was in the late 70s. From that point, it grew until the early 2000s when the first baby boomers began to retire. And as boomers retired, the percentage slowly declined since and is now expected to stay in its current range for the foreseeable future. And moving on to layoffs. While we've seen some layoff announcements in technology and areas of the economy that were a bit bloated, in general, weekly new unemployment claims haven't increased at all, despite much, much higher rates than 2 years ago. And in our view, this is driven by the fact that there are still many more job openings than unemployed workers. Employers are opting to train existing workers in areas of need rather than laying people off, since it's very difficult to find good workers who are out of work that may have a skill set that an employer is looking for. Our next slide, moving on to the optimism level in the private sector, shows the Purchasing Managers Index for both the service and manufacturing sectors of the U.S. economy. So essentially, these readings reflect the level of optimism or pessimism in the private sector. A reading above 50 suggests that expansion is expected, while a reading below 50 suggests a higher chance of recession. Right now, both readings are modestly positive, but not extremely so, despite higher interest rates. And over the past year, you'll notice that confidence in manufacturing has actually improved a bit, while confidence in the service sector has declined slightly. Now, as I mentioned a minute ago, from an absolute basis, neither of these readings are extremely high. And in our view, kind of reflect an attitude in the private sector that we just need to kind of buckle down and get through this period of higher than average inflation and interest rates before the private sector can really get more optimistic about making investments on expansion. But nonetheless, the economy has, as we've shown, it's still been growing. Our next slide shows the leading economic indicators index, which is a measure of 10 factors that may, but don't necessarily project the direction of the U.S. economy. A reading above 0 reflects an expectation of growth, while below 0 suggests a higher than average chance of recession. Each quarter, when we show this graph, we emphasize that direction is more important than the absolute value of this index, and that a reading below 0 shouldn't in itself send everyone running for the hills. And to prove that point, the leading indicators index has been below 0 for close to 2 years now, with no signs of a recession on the horizon. We do believe that the stability of the readings in the index in 2023, despite low readings on an absolute basis, as well as the recent uptrend in the index, are both positive signs that reflect the general feeling among economists that a recession in the near future, while always a possibility, is getting a bit less likely. Now on to the consumer. Consumer confidence has remained solid and somewhat range-bound over the last 2 years since the Fed rate hike started. This level is, you'll notice, certainly much lower than in the few years prior to the pandemic, and this is due mostly to higher prices. It is, however, excuse me, much higher than at any point between the financial crisis through late 2016. And we've talked about this a lot in the past, and we feel that consumers were snake bitten for a number of years after the financial crisis because so much money was lost in the capital markets and so many jobs were lost. It took a while for people to get confident again. Now, with unemployment right now being where it was in the 2018-2019 period, really the main difference for consumers right now between 5 years ago is the cost of living. Prior to the pandemic, inflation was very low and the job market was strong. Now the job market is strong, but inflation is a bit higher and was certainly much higher a year and a half ago. So moving on to retail sales, this is where we think inflation and higher interest rates are weighing on the consumer. So consumers are saying they're relatively confident, but higher borrowing costs coupled with higher prices are squeezing budgets. This in turn is putting pressure on retail sales growth. You'll notice, relatively tepid growth recently. That being stated, it is important to point out that the growth ratings on the left side of this chart were unsustainable and fueled by government stimulus, extremely low interest rates, and low baseline figures when we came out of lockdown from the pandemic. So, the growth figures on the very left-hand side of the page are not target. But the expectation at this point is that retail sales will be able to accelerate a bit once the Fed is comfortable enough with inflation progress that they can reduce interest rates. That combination of price stability from less inflation and lower borrowing costs should give consumers a bit more breathing room in their budgets. And onto inflation. This graph shows us the Personal Consumption Expenditures Index, or PCE. And this is the Federal Reserve's preferred method of measuring inflation. And the Fed tends to focus most on the green line, which is called core inflation. This is inflation without food and energy costs, which tend to be volatile and unpredictable. The blue line measures overall inflation. And you'll notice that both measurements have been declining over the past 2 years. So the Fed rate hikes have done their job to an extent. That being stated, recent data suggests that progress appears to be slowing a bit, which has caused concerns over the past month or so about when the Fed will actually cut interest rates. And Jerome Powell stated that rates are sufficiently high enough to bring inflation down to the Fed's 2% target. So rate hikes don't seem to be coming in the near future, but that cutting rates in the near future could risk progress that the Fed's made over the last 2 years. And that's why we haven't seen any cuts yet, despite progress against inflation, and may not in the near future. And it's very important to keep in mind that inflation measurements are an average of price changes, and prices don't rise or decline uniformly across the board. This graph contains a list of some of the components of the consumer price index and how much those components changed in price from October of 2022 through September of 2023. This is the 2023 fiscal year. Overall, CPI increased by 4.1% over that 12-month period, again, from October 1st of 22 through the end of September 23. And as we all have noticed with our weekly grocery bills, food costs increased fairly significantly. Labor and part shortages have increased motor vehicle repair costs. Another component not shown on this chart that's gotten a lot of attention the last couple of weeks is car insurance prices, which rose over 20% in the calendar year 2023. But you will notice, though, that prices have decreased in some areas. Energy costs decline as oil prices dropped. As supply chains normalized, TV and telephone costs decline. Used car prices also declined as new car production finally started to catch up with demand. Another big decline that isn't shown on this graph is the price of eggs dropped drastically in the full calendar year 2023. So the point of this is to show that inflation is an average. It's not just it's not a situation where prices just rise uniformly across the board in all areas. So our next graph shows the Fed funds rate on the left-hand side and the 10-year Treasury bond rate on the right. The Fed funds rate has remained constant at a rate held between 5.25 and 5.5% for the past year, and will likely stay there until the Fed feels comfortable cutting rates. And when the Fed does move, it will likely do so very deliberately. And this is to avoid the possibility of rekindling inflation. And quite honestly, we understand exactly why the Fed isn't cutting rates yet. There is more to lose at this point than to gain by doing so. GDP is growing, unemployment's low. Cutting rates too quickly in this sort of climate where there isn't much excess labor supply could cause a reversal in the hard-earned progress that we've made against inflation over the last 25 months. Now, moving to the right side of the graph, we see the 10-year Treasury bond rate, which has risen a lot so far this year. So it started the year a little bit below 4% and is now back up to about 4.7%, which is where it last was in the fall. This has been driven primarily by expectations of Fed rate cuts being pushed back to later in the year. At the end of December, some economists thought we'd see 6 or 7 cuts this year. At this point, 1 or 2 seem much more likely. And there are even some economists questioning whether the Fed will, decide to cut rates at all in 2025. And as always, whenever the Fed speaks, Jay Powell says that everything they do will be, quote, data dependent. So they're constantly looking at data that comes in and making decisions about when when and how they may ultimately cut interest rates. Our next graph shows that short-term interest rates are higher right now than long-term runs. So short-term rates are purple, 10-year rates are orange. This phenomenon, of course, is called yield curve inversion and isn't very common. Usually longer-term rates are higher than shorter-term rates because if you lend money to somebody for a longer period of time, you usually expect to be paid more interest for locking it up for a longer period. But what's happened is the Fed has temporarily raised short-term rates significantly, and they really control short-term rates. And the long-term interest rates kind of float based on that. And the fact that long-term rates are not higher at this point than they are suggests the belief that the Fed will win this inflation fight. So, for example, if investors weren't confident that would happen, they would demand much higher yields for 10-year bonds. So, for example, nobody's going to buy a 10-year Treasury bond that pays right now 4.6 or 4.7% if they believe that inflation will be 7 or 8% per year indefinitely. That's a losing proposition. On a real basis, adjusted for inflation, you're getting back less than what you put out in the first place. Now, once Jay Powell feels comfortable reducing short-term rates, we expect the yield curve to normalize. The Fed views what they call a neutral rate, essentially equilibrium, where they're not squeezing the economy or helping it. They view that rate at around 2.5%. So that's likely where they will kind of let the rate settle eventually once they get inflation down the target. That will probably pull the 10-year down some, but maybe to like the 4% range. So when the Fed is finished with this cycle, we would expect the yield curve to normalize, where we get paid more interest for intermediate and longer term bonds than we do for short term ones. And all of this, of course, getting the Fed back to target, it's going to take some time. The economy's relatively strong. That last mile in the inflation fight is going to take a while, as long as the economy holds up. I mean, if there were to be a recession, inflation would probably drop very, very quickly. And that's, the Fed's taken the view that they'll be deliberate unless there's some sort of economic duress that forces them to move more quickly with interest rates. Now, on to mortgage rates. While still below 2023 highs, mortgage rates remain elevated. As of the end of the first quarter, the average mortgage rate in the U.S. was 6.79% for a 30-year loan. As of last week, that rate broke through 7%, and I think is around 7.25% or so now. High rates have kept a lid on home prices, which has really been important in the inflation fight. So home prices haven't declined much, but nationally, they kind of stopped going up with much higher interest rates. And our expectation is that mortgage rates will decline a fair amount once the Fed starts to cut the overnight lending rate, just like the 10-year rates will likely come down a fair amount. Now, outlook for the next quarter. As we go through the second quarter, here are a few things we'll be keeping a close eye on. As always, the Middle East is a tinderbox. With Israel and Iran exchanging direct attacks recently, the odds of a regional war appear elevated. While the U.S. has said that they wouldn't participate in any offensive operations against Iran, just in helping defend Israel, the situation still bears watching, particularly for its potential effect on oil prices. On the interest rates, expectations of rate cuts recently have been scaled back. This certainly has dampened short-term market enthusiasm a bit in the month of April, slowing progress the past few months against inflation and solid economic growth. Makes people wonder right now when the Fed will actually decide to cut rates. And at this point, most think it'll be sometime toward the end of this year. In general, as Alex showed on the charts, equities have still done well in 2024, despite pulling back some during the month of April. The big question at this point is whether investors will continue to buy equities aggressively if they start to believe that high cash yields will remain an option for a longer period of time. Essentially, what happens is ahead of expected rate cuts, people who have a lot of cash tend to move that into longer term assets because they know they won't get a good cash yield for very long. Lastly, moving on to the election season will start to heat up further over the next couple months. So far, the market's taken the possibility of either candidate winning somewhat in stride. Whether that continues through the election season is unknown at this point, of course. And so that concludes our prepared remarks for today. I'll turn the call back to Alex, and we'll open up for Q&A.
Thank you, Ed. And it has been a very interesting 4 years. Starting when COVID really kicked off back in early 2020. We saw one of the most rapid bear market crashes that we've seen in market history. We saw an unprecedented amount of stimulus created and money printed. We saw a rebound, the likes of which we could never have imagined when we were at the depths of the market downturn in March of 2020. And then we saw inflation that we haven't seen since, probably early 80s. And it's a very distinctly unique environment. Every environment is unique from multiple different perspectives, but there were so many low probability things that occurred in a row, just raising a lot more uncertainty. And frankly, I'm more surprised that we haven't seen as much volatility. I would have thought that over this period of time, we would have seen wilder swings than what we've seen now. But we've been relatively complacent through this. And that's not a bad thing. I think the market's complacency is a testament, again, to the fact that the American business, the American consumer, and really the population of the world is driven by this need to create economic progress. And there is some optimism that can always be found. Well, we don't have any questions. A little bit of a sparsely attended webinar today, but that's fine. It's a gorgeous day. We hope that people get out and enjoy it. So with that, I will conclude the presentation now. Thank you all for coming. We hope that you have a wonderful remainder of the spring. Have a great weekend, and we will look forward to catching up with all of you individually at some point in the not too distant future. And because I have to put these disclosures on the screen for a second, I'm going to do that and keep all the regulators happy. And if anybody does have any last minute questions, oh, wait, one just came up. No, it was just a thank you. Oh, darn, I got excited for a second there. But anyway, you are very welcome. Thank you for attending. And I hope that everybody has a wonderful rest of the day and enjoy the season. We'll talk to you soon.